Welcome everyone. This is the Startup Investing session. Before I go too far, can I ask people to help us out a little bit? The panel and I wanted to know who was in the audience. So what we would like you to do is stick up your hand if you're an angel investor, and keep your hand up if you've done one deal. You've done more than and then keep your hand up if you've done more than 5 deals. Okay. And then the next question is, how many in the room are startups looking for investment? And keep your hand up if you found investment, or swap it around, whichever. Okay. All right, so my task is to introduce our wonderful panel. And the first person to speak is David Hulston.
Hi, I'm David Hulston. I'm an angel investor, and I say that it sort of sounds like a confession of being an alcoholic or something. But so my journey to become an angel investor, I'm originally from the Gold Coast. I live in the UK. I've been in the UK now for outside of Queensland for the better part of 30 years now. So I was an accountant when I left the Gold Coast. Went to London and worked as an accountant, worked in the Far East for a number of years in finance roles. Went back to the UK in the early 90s, and I worked for what at the time was Thorn EMI, which was a large electronics conglomerate with a music company. At that time, the 3rd biggest music company in the world. And they were looking to demerge to recreate EMI, the music company, again. So I was involved in selling off technology companies all over the world. And they had things from Kenwood appliances to missile fuses to television manufacturers, all sorts of different businesses. And once most of those were sold, they ended up with a music company and a big corporate lab full of guys with beards and sandals. So we did a management buyout of that corporate lab, a bunch of scientists, all physics-based sciences, no life sciences. And we spent some time shooting some of them and the rest of the time turning it into a business. We managed to turn that into a proper business, float that on the London stock market in 2000, minutes before the dot-com crash. So we bought that very cheap and sold it for a lot in a very short period of time. So we did a management buyout for £3 million, did an interim VC round on the way that valued it at £30 million, and then listed it for £320 million, all in the space of about just under 4 years. I worked running that business for a few more years, and then left in 2003, and since then I've been investing in very early stage tech companies, all in the UK, and now I live in Cardiff in Wales, and most of my investments are there in South Wales. So that's how I got to be an investor.
Thanks, David. Dan?
I'm Dan Gavel, Director, Investment Partner at Black Sheep Capital. I guess you'd term us kind of an early stage family office. As a financial planner for 10, 12 years, I know a lot about investing and risk in that time. My biggest client and I kind of sold up all our assets, pooled it, and set up Black Sheep Capital. We're part early stage investors, part property developers, part mezz financiers, but really the focus at the moment is the early stage tech scene. And it goes beyond just investing for us. Like, we try and get fairly involved and involved with the scene to help it grow, because it's good for everyone. But been investing as an angel early stage investor for probably 2.5, 3 years now, and happy to answer any questions.
And Anne-Marie?
Hi, I'm Anne-Marie Birkill. I have actually a request. I'd be really happy if any people coming into the room would come into the middle, because it's like there's nobody there. So if we could all squidge in a bit, that would be great.
Or we'll move over here.
Or we'll move over there.
Yeah.
So I'm a partner in venture capital fund One Ventures. We're technology investors. We have about $170 million in funds under management. I started my career in plant biotechnology, and I know a lot about growing little plants in test tubes, and I also know a lot about growing insects en masse, which is another whole subject that you can ask me about over lunch if you've got the stomach for it. I'm on the investment committee for the Advanced Queensland Business Development Fund. I've been involved, my sort of passion is women's entrepreneurship, so I've been involved in Women in Technology and Springboard Enterprises as a director. I suppose you could say my career's been built in the technology sector, both as a manager. I ran an incubator for a while, and now I'm a venture capitalist.
Thank you. So we're going to launch into some questions that we've discussed amongst ourselves to best address this topic. So the first question is going to start with David, and it's, are new models of funding, i.e. crowdfunding, making more capital available, resulting in higher valuations?
Well, I think there's two parts of that. So is there crowdfunding? So I think from what I understand, what's happening here is there's very little crowdfunding happening in Australia yet. It's quite immature. The UK is probably the most mature place for equity-based crowdfunding at the moment. And we're seeing different models start to develop. And we're also starting to see some fail, I'd say, as well. What we're really seeing that actually works are the angel-led crowdfund models.
Okay.
So things like Syndicate Room and Angel's Den, if those names mean anything.
Yep.
But certainly look those two up. So they work on the premise that there must be an angel leading around. And there are others that don't work on that model. But the reality on the other models, and the two other successful ones really are Crowdcube and Seeders. And the real reality there is, unless an angel is leading the round anyway, you don't get the money, because they tend to be at least 30 or 50% of the money has to be immediately going up saying, I've already raised this much money,
yep.
Or no one comes into it as the crowd. That leads straight into the valuation question, because that's the break on the valuation. That's the sanity checker on the valuation. Angels take their approach to getting the right value, and angels don't. Serial angels don't invest in overinflated valuations. So,
no, they don't.
So, yeah.
Dan, Anne-Marie, any comments on that one?
Look, I think that Dave's comment's accurate. There's very little crowdfunding in Australia. I think it's a lot of airtime for something that doesn't actually contribute very much capital to the ecosystem.
To the ecosystem, yep.
I think that in some sectors in Australia, valuations are overinflated, yep. And I think there'll be an adjustment in some of those sectors moving forward. But I don't think that's the fault of crowdfunding.
No.
I think it's in part associated with the fact that relative to perhaps 6 years ago when we launched our first early stage fund, there's quite a lot of early stage funding now available in the market. And I know entrepreneurs don't like to hear that because, of course, it's still hard to get.
Yep.
But relative to later stage funding, there's more funding at the early stage.
Oh, there is.
And therefore, that availability of capital means that entrepreneurs can command slightly higher valuations in some cases, yep. But you also you get a variety of different sort of investor approaches to valuation, and that can skew the market.
Right. I mean, the thing that, as part of an angel group, that we notice is that there's more and more syndication opportunities with other angel groups, and yes. I think that works really well.
Absolutely.
And not necessarily pushing up valuations, but maybe right valuing the company because so many people
Perhaps.
Are going through it. Okay, so I'm going to ask this very important question. What are the advantages of early stage, of investing in early stage startups? And anyone can go first.
I mean, advantages compared to what? You know, like my advantages would be completely different to Anne-Marie's, would be completely different to David's. You know, it is a risky business, but at the end of the day, you know, the quote always comes back to me is I never go into anything planning to fail. You know, we've got a very systemised approach to how we invest, what we'll invest in, the sort of things we put founders, business concepts through. So, in all honesty, like maybe it's me being a bit skewed, but I don't particularly see it as overly risky, because when we invest, we don't we don't go into that putting, well, I'm putting $2 million into something that's going to potentially fail, because if you do, you should probably not have put the money in. You know, it's like it's essentially the same as establishing any business. Any business is going to have a set of risks, it's going to have a set of problems that you've got to overcome, and I don't really see the innovation section as being any different to most other big business situations.
Yeah, absolutely. I don't think I'm very smart, so I can't do stuff that I don't know. So I can't invest in property. Every time I do, I get it wrong. So I don't do that. So I know something about investing in technology businesses. So that's already me de-risking my investment profile. So the fact that all I do is invest in technology businesses may make me mad, but you know that's all I know how to do. So.
And what do you compare it to? Like, I have the argument when someone says, "Oh, I buy the Australian stock market," and you go, "Well, congratulations! Anything out of the top 200 is probably as risky or more risky than a startup."
More risky because you don't know what's in it.
Well, and at least I can talk to the founder. You know, if I'm invested in a startup.
Yeah.
Anne-Marie, you.
I'll leave that one alone.
I'll leave that one. I guess my personal one on that is that I post the GFC, and I think the discussions that have been happening both yesterday and today, that point in time is often referred to, but it's interesting how the startup ecosystem has evolved quite substantially since then. And in my own personal situation, I haven't invested in the stock market since the GFC. And I've only invested in startups, mainly because of what everyone's really pointed at, is that you can touch your investment, have a say in your investment, and that doesn't mean taking control of your investment, it just means contributing to the success of that investment, which is a kind of de-risking.
Yeah.
Well, I mean, you could ask anyone that invested in BHP how safe it feels now, right?
Yeah.
Okay, so now that we've talked about safe, we can go into risk. So how do you minimise risk? Anne-Marie?
I think this is a really important question, and I think, you know, part of the answer to your previous question around why invest in early stage is you know, rather than later stage, perhaps. That's a good way of looking at the question. And, you know, the difficulty with early stage technologies is they're not always successful. So one of the keys to mitigating risks for investors is doing what most of the angel groups do, and that's syndicating deals. So syndication enables angels to spread their investor capital over more investments. Yep. So, you know, perhaps put $20,000 or $50,000 into 10 or 15 investments instead of, you know, 500,000 into one. And therefore, if one fails or doesn't perform brilliantly, then chances are that'll be balanced out by another that does. Because, I mean, for those of you who are investors, you'll know that portfolio theory tells us that even in a well-selected portfolio, out of 10 investments, one might be wildly successful, you know, 3 or 4 might be moderately successful, and there'll be a few that'll just be bust, no matter how clever you are or experienced you are as an investor. So you need that spread in your portfolio to de-risk, and I think that's really critically important. And for those of you who are thinking about entering the angel investment space, or, you know, considering making those first investments, I would encourage you very strongly to find a way of syndicating and through one of the formal angeling groups is a good way. The other sort of things that can help to mediate risk are things like having downside protection in your terms of investment. So most professional investors will look for example, preference shares. Entrepreneurs might not necessarily like that, but in the event that the company is successful, the benefit to the investors typically washes out. It's when the company's sort of only moderately successful, or, you know, and you just need to be able to get your money out, that they come into play. So those sorts of terms are important for investors in terms of mitigating risk. And I'll make one more point before I hand over to the other panellists to make their comments. The other thing is most successful investors will invest in areas where they have some expertise or ability to make a contribution.
Yep.
And again, if that doesn't come from you directly as an individual, chances are if you're part of a syndicate, there'll be somebody else in the syndicate that has got that experience. And a good way to talk about that is to use an example. So One Ventures, as venture capitalists, we have now 11 portfolio companies. The Brisbane Angels have invested in 2 of those portfolio companies as co-investors. They're both life sciences companies.
Yep.
The 2 investors that supported those investments into the Angel Group really get life sciences, so they can lead the investment within the Brisbane Angels, make a contribution to the company, and give the rest of the investors in the syndicate some confidence that there's expertise that is able to make the sort of judgments about the quality of the investment.
Absolutely.
And look, I agree with everything on that broader risk sort of term, and coming from a financial planning background as well, I also would caveat the going to an angel syndicate with also, if you go to a fund manager to invest in the Australian stock market for you, if you go to like a term deposit specialist or a fixed income specialist to invest on your behalf, then the same argument could also be applied to the innovation section. Why wouldn't you invest through a venture capital firm if you can access it?
Yeah.
Most importantly, while you educate yourself on the ecosystem and how it works. And I think one of the most important risk factors for us, for me personally, is understanding what you can afford to lose. Don't walk into an angel syndicate and go, I love this, I'm going to put $100,000 off my mortgage, pull it back and chuck it on a tech startup, because look, generally that's not going to end well, For us as professional investors, I guess we've identified over the last 3 years that the biggest risk is the founder. No matter what, a lot of people go, well, we spend 70% of our investment decision on the quality of the founder. Well, for us, this was so important to us that we're actually now building like a tool in-house to do founder assessments, because to find out their cognitive reasoning ability, their ability to handle stress, their ability to handle bigger picture items, because it is the one constant in a startup. The one thing you can rely on is the founder's going to want to stay there. And trust me, there's been cases where you've met with a founder and 4 weeks ago they were an app that's going to change the law, the way the law is written and advised on, and 4 weeks later you meet them and go, so where in that time did you become a fitness app? The one constant is the founder. Through pivots, through changes, through market shifts, the one constant that you can rely on is a founder. So us internally, we're completely shifting our focus away from the business and moving it onto the people, because the people are the one thing that you're going to have to rely on during your 5 to 7 year odd journey of investing in a startup.
Yeah, absolutely. The thing you're investing in is always the person, the team, the founder, and all the people around him. It's rarely any more than just that. So.
Can I ask Dan, and both David and Dan, there's a question that's come up that I'm going to interrupt our schedule on. What do you think is the best approach to minimise risks for retail investors for equity in startups, and regulations currently around that?
Well, I mean, the first issue with that is, unfortunately, the innovation space in a diversified and portfolio approach manner is excessively hard for a retail investor to enter. I say that by the strict terms of what a wholesale investor versus a retail investor is, on the basis of like the ATO, $250,000 a year income, and then another, or $2 million or something you can invest as well.
$2.5 million, I think.
$2.5 million. And, as a retail investor, and from my financial planning background, I always go for diversification of assets. So if you can enter the investment market, the way to minimise that is to do it through a professional and do it in a diversified portfolio, someone that is matching the sort of risk you want to take. Anne-Marie touched on it before. There's different levels of growth that you can invest into in the innovation world. Seed, angel, Series A. You want to minimise your risk, go for a Series A, Series B fund. You want to really double down, go for a seed fund.
Yeah, absolutely. It's I mean, I'm not sure what the bounds are in Australia in terms of retail and wholesale. But the point is, I think from experience, when people try and invest their first investments in early stage startups, you've got to be looking at the first few that you do are probably going to disappear before your very eyes, is the mindset that you need to have. That may not be the circumstance, the results, but do not put your house on the line investing in a business that somebody else is running, somebody else is doing. Why on earth would you do that? So don't believe that you're investing in Facebook for cats just because some guy says he's going to make lots of money for you. That it doesn't work out like that. The first few investments are likely to go absolutely pear-shaped unless you're working alongside other people that really know what they're doing. So that syndication idea, the angel group idea, that's the way to start to learn what the process ought to be.
I'm actually going to go out on a limb and say I don't think that startups the place for retail investors. So that's my opinion. It may not be everyone's opinion, but I think it just, I mean, Dan made the point earlier that early stage investing isn't necessarily risking, but he's talking about it in the context of having people that know how to manage investments, portfolio spread, all those elements that we talked about earlier. I think for a retail investor trying to place one or two small amounts of money, it's very risky and they shouldn't do it. That's my personal view.
And look, in all honesty, from conversations I've had with the likes of Australian Super and Host Plus and all those, to be honest, I would say 90% of you in the audience will probably have access to it through your super funds in the next 5 years anyway. It might be the best place to start. In all honesty, like you don't go and start investing in hedge fund style investments because it's flavour of the month. You know.
It's a pretty crazy place to invest your money if that's all the bucket of money you got. Yeah.
I like this question. Do you want to handle that one first, or do you want me to?
Yeah. So the question is, when is the right and wrong time to approach VC or angel investors? I'm not sure if you can see the question out there.
No, they can't. It's us that
so I might start, and I'll give the VC perspective, and then perhaps let my colleagues answer the angel perspective. So I think from the point of VC, the first thing is to understand what the investment strategy of the fund that you want to approach is. So we have two funds. Our first fund is an early stage fund. Our second fund is a later stage fund. So clearly you're not going to come and approach One Ventures if you're looking for seed funding, because we're a Series A and beyond funder. So first of all, understand what stage they're investing in, what sectors they're investing in, have a look at their previous investments, and if you're a good fit, it's a good time to approach them. The second thing that I would say is it's always, if you look at, so we have 9 portfolio companies, and if you look at where they came from, almost all of them have come from a warm introduction. So if you can find someone that knows a partner at the fund and have them introduce you, that will give you a little bit of a sort of a step up in terms of having your opportunity considered more seriously, because we do see a lot of investment opportunities. So make sure you're a good fit to the investment criteria, and make sure that you get in some way other than just a cold call. That would be my advice.
Honest to God, the right time is probably at the pub on a Friday afternoon, but don't bother talking to me about what you're actually doing with your startup. And to be completely blunt, I want to know you before I know what your startup's doing, because like Anne-Marie said, our rate of cold approaches through our website or direct approaches at the moment is 0 from our whole portfolio. Our leads come from, and it's like anything when you're talking about strong investment decisions, they come from qualified sources who operate in a very similar manner to us. So if you don't have that direct access, then I would suggest you start finding ways to access us like before you want to raise. And I mean, like, as if we get people come with 3 months, I'm closing my round, it's now the 29th of April, I'm closing on the 15th of March. You're like, okay, and you've got how much money left in the bank? Like, don't leave it till the last minute, and start early. Start getting to know the investors you want to work with. Like, we're all around at enough events and in the community and stuff enough that it's going to work better if you approach it warmly. You don't approach it with just, I need money.
Yeah, and you're unlikely to, at very early stage, be able to go straight to a VC Because, the VCs aren't investing at the stage I'm investing at. So part of what my role almost is nurturing the business to the point that they should be talking to a VC. So therefore, I'm nurturing the relationships with the VCs. So I'm having a drink with the VC on the Friday night to make sure that when something is interesting, I can say, this is one that you should talk to. And making sure they're not talking to the VC too early and making a mess of it all.
And I would also add that it is a really narrow thought construct to go, when do I go from, to think VCs and angel investors are the only people that are investing in the innovation space at the moment. A lot of money we're seeing is coming from high net wealths who are working in the industry that startups are focusing on, their family offices. There's a lot of money outside of VC world that's liquid and available and may actually be easier to access just due to due diligence constructs.
Yep.
Yeah.
Now, this question that's come up a couple of times, it's linked to the others. So we've spent time defining the qualities of who we would like to partner with. Is this approach important, or is it better to get money any way you can? And that is an important question, because we've been discussing the money any way you can prior to who's going to do that?
Well, the first part of it is really good, that you're looking at your investor as a partner.
Yep.
That's really good. That's really important. From my perspective, I look at all of the people I invest in as being partners. If I'm going to give you money, it is in my interest exactly the same as your interest to make the business work. So, good, you've got that concept well defined. The reason I say that in that way is lots of people don't. They see the investor as somebody only to grab the money off, and then you remove them from the equation. They've got to be part of the journey. You want them on that journey. So in the second part of it, don't take money from just anybody. You don't want, and I'll just say dumb money. You don't want to just take dumb money. You don't want money that doesn't bring anything other than money. You need money that adds value to it. Money's only to you a very important component, but in reality a very minor component of what you're getting out of an investment. The thing you're getting is it's the contacts, it's the stuff we've seen go wrong with other people, it's the things that you're going to hit that we know about, how you scale a business and how you build and grow that. That's far more important than the money. So choosing that right partner is absolutely correct, but keeping him as a partner.
Well, and caveating that as in an ideal world, in an ideal process, yes, you would want someone...
I only work in ideal worlds.
Well, but at the end of the day, my finish to that is that if you need money and it's not coming from smart money, my hat's off to you if you just don't take any money that's willing to be given to you, because there comes a point where you just want to be funded, But that's actually an interesting question, because it goes both ways. Because there's been times for us where we've looked at startups that we really shouldn't have been in the round for and gone, well, we love this investment so much. What can we do to get involved with you? And that's not to say we're dumb money. We just can't add a level of value to maybe sector specific or they're further advanced than where we would want. But we look to try and get into those sorts of investments as well.
Yeah, I might make a comment, and one of the founders of one of my portfolio companies is in the audience tonight, so I'm going to look at him for some affirmation. But I think that it's really important to say that if you take on board an investor, it's like a marriage. We're going to be dating for the next 5 to 7 years probably, and we're going to go through some really bad times probably. Most companies do. I mean, I've had companies where I've gone to Christmas Eve not thinking I can pay payroll the next week, which is a pretty scary place to be. And we're going to go through some really good times. We're going to celebrate those together. But really our role as an investor, well, it's certainly we take the view that our money is just the starting point. We're mentors, we're partners, we're collaborators, we're we're there for the ups and we're there for the downs. And if we can't add value, we won't invest. Certainly that's how we see our role. And I can say without any fear of being contradicted that in all the portfolio companies that are part of One Ventures at the moment, the partners have added a lot of value as directors and all those other roles that we take on.
Okay, we've still got a couple more questions on our list, but we keep getting great questions.
That's a good question.
And I want to answer this one a little bit.
Go for it, Aysegul.
So, should I see a lawyer about protecting my idea before I see an angel or a VC? Now, I'm pretty sure VCs operate like angel groups where we have a code of conduct. I personally have a huge interest in doing the right thing, and therefore I would encourage you to see a lawyer about your IP as early as possible, but I would also encourage you to be involved in an incubator or an accelerator, or just what you don't know, get people around you that can help fill in the holes in your knowledge base. But angel groups generally, especially if you're going through a syndicated angel group, it's part of their code to not do the wrong thing by you, because it's really not in their interests.
Yeah,
I could probably answer that a bit more directly. The answer is you're probably too late, because if you have started to talk to commercial arrangements about it, you've released it to the market, which is about the time that you're speaking to an angel or VC. I'm not a solicitor, and I caveat this with check it, but in my experience, if you've actually released it to the market, it's too late to protect your IP, because it's then commercial and it's then in the open market.
In the public domain.
Yeah.
Yeah. So I would say I get asked to sign non-disclosure agreements quite a lot, and I personally won't sign non-disclosure agreements, not because I want to know your secret and I'm going to do anything with it, because there is only one asset that I actually trade on, and that's my reputation. So if I was to get a hold of your idea and go and do something else with it, that's gone. So that's the end of what I do. The other thing is I'm a lazy bugger and I don't want to build whatever it is that you're doing. That's your idea, not mine. I'm not going to make whatever your thing is. I'm not going to develop your Facebook for cats. It was a great idea, but I don't want to do it, thank you. But so I won't sign a non-disclosure agreement. But I would say that you shouldn't get too hung up about it, because if your idea is good, you're still going to have to shove it down people's throats, not just say, I've got something that's really good. That's your idea, it's really good. Of course it's really good from where you're sitting, it's your idea. So you've got to be able to articulate why it's good. So you're going to have to tell me what it is.
And I think there's some there's some websites and stuff you can access which can give you some clear thought direction on, firstly, whether your idea can actually be protected, because it has to be new, novel, unique, and a whole range of things. Yeah. And then you're talking an early stage startup which probably only has $25,000 to $50,000 in the bank or something, and then you're talking about, well, am I going to protect the IP in China? Am I going to protect it in the US? That's like a $20,000 to $30,000 question right there. And look, like you say, we're not going to steal. We had one of the example is we had a quantum computer company contact us and go, here's an NDA. And I said, mate, I can't even access a quantum computer. Why am I going to say an NDA to say I'm going to steal your idea?
Yeah, yeah.
I know we're labouring this point, but could I just make two quick comments? I think, first of all, the answer to this question depends on what sort of technology area you work in. Yep. So, most of you probably know there's many different ways of protecting your IP. If you're developing a new drug, then presumably by the time you're looking for investment, you've gone a long way down the path of ensuring that you've got a patent in place, just to use a sort of a generalist example. So if you're a life sciences company, by golly, yes, you'd better have gone and seen a lawyer before you're talking to anybody. If you're talking about protection through, say, copyright on code or something like that, that's implied anyway, so you don't actually need to seek legal advice. So I just want to make the point that it's horses for courses, depending on your area, your field. The second point is that a really important skill for you to develop when you're talking to investors is being able to talk about your technology in a way that can be shared in the public domain, whereby you don't disclose the underlying secret source, if you like. So developing that skill is a really important attribute as an entrepreneur. And there's many ways that you can, go to an incubator, talk to someone else who's been out there before about how you can talk about your technology in a way that doesn't disclose the essential sort of core.
Yeah, we don't want to know that at the start.
No.
We're looking at what's the problem you're solving and how do you solve it and how are you going to get money for it. So we don't need to know the finer mechanics of it. So you can articulate it without telling us the secret source.
Right. And the reality is, everyone has I have ideas all the time. I don't want to execute on them. So when we are looking at investment opportunities, we are looking at the people. Dan mentioned it earlier. It's about the founders. Are we going to invest in the founder? I've just noticed another question which is really, really important, but I wanted to make sure we have time to actually finish off what we were talking about. So, can you actually make money? Obviously, we all believe you can in early stage, as an early stage investor. And related to that, how do you pick awesome startups, what to look for? And this is really important because we're talking about the early stages. And Anne-Marie, I'm looking at you, so I'm going to give it to you first.
I'll start off. Look, I think this question is really related to that question of risk. Certainly lots of angels and venture capitalists have made really good money out of investing in startups, but I think if you were to analyse them, you'd see that a lot of the sort of key factors are in common. They've applied good portfolio theory, so they've typically invested in perhaps 15 different companies, and they've got portfolio spread. So, one goes up, the other goes down. Overall, they'll tend to make money. They've invested in areas where they have knowledge and expertise, either as individuals or within their investment syndicate. They've put in place those protection methods in their terms and conditions, and they've also been fairly scrupulous about valuations. One of the good reasons to say no to an investment is if you think that the valuation is toppy, because as an early stage investor, you're going to get diluted unless you can participate through future rounds. So if you invest at a high valuation, then you're just doomed.
The answer, yes, because I want to make money and that's why I do it professionally. But at the end of the day, I think yes, but it's got to be in a professional sense. It's going to be extremely difficult for you to make money from your portfolio if you don't have a professional system and process behind it. And that starts with from bottom to top, from when you first engage them to do due diligence, to meeting with them, to helping them grow, all the way through to helping them exit. Anne-Marie's probably the only one on the panel that's actually, on you as well, who have been through that whole stage, and it's not easy and it's hard work, and it doesn't happen as a Tuesday night exercise where you put an hour into thinking about what you're doing for your startup. Like my role is to network with potential partners for our startups, to find partnerships, to actively seek to work to understand more about the startups we're working with, the sectors, the industries. It is the same approach that a property portfolio manager would use, a hedge fund manager would use. You're putting a professional approach behind it, and I personally think that gives you the best chance of making money, but trust me, it's not a guarantee.
Yeah, it's not a guarantee, and it's also quite a long journey.
Yes.
The mythology is that you will get return in 2 or 3 years, and that is mythology in nearly every circumstance. It does happen, so there are circumstances. Every book that every entrepreneur out there will pick up will tell them that in their pitch deck they need to say they're going to exit in 2 to 3 years. That's just rubbish. Yeah. Don't even say it. Tear that bit out of whatever book it is you're reading. Throw it away. I don't want to hear it. That's crap. It just doesn't. Life don't work out like that. Or maybe it's just my experience. But it's I've been doing this for a long time. It's about a 7-year cycle, I think, and businesses sort of go up and down, and it's a hard, long journey, and it's about, on average, about 7 years before you exit businesses at a decent return. If you've exited before, you might get lucky, or you haven't really got much value. It's bloody hard work for us as well as for the entrepreneur. And so you're looking at a 7+ year investment, not a quick buck.
And as you would from an investor looking at the founder, I would strongly encourage, if you're going to be investing through a professional fund or something, to do the same sort of due diligence, wins on the board, strong portfolio sense, and on paper success with us. There's going to be a lot of funds coming to the market soon from people who are just kind of see this as a hot topic and come out of Macquarie from a completely different team to this. And those are coming back to the question about where I think valuations are going to get skewed from. It's going to get skewed from that sort of high-level money coming from super funds and all that sort of stuff, and more things getting invested than what is necessary. In the words of, I guess, Johnny Cash, you got to know when to hold them and when to fold them. There's times when you've just got to go, despite this looking like a great idea, it doesn't fit my methodology, or I don't see it working in the longer term, so walk away rather than just keep throwing money at that sort of stuff. It's knowing when to double down, when to walk away, when you need to step up your interaction, when you need to call in the troops and the help and use your networks that you can to help leverage your portfolio. And it is hard to do that from a singular person operating in a one-off sense. The angel syndicate groups give you some buying power in that you've got multiple people working from it, but you've got to find what you're comfortable with and run with that.
Okay, so as the only person, actually Anne-Marie is a member of Brisbane Angels as well. One of the things about being part of an angel group is there is a great deal of learning offered from the group. And if you are, based on this morning's discussions around the startup ecosystem and the development of the ecosystem in Brisbane and other centres around Australia, it's really, really important for startups to mingle with angels. And in Brisbane, we're really lucky. We have a number of really wonderful accelerators and incubators that we as angel investors can be part of, mentoring startups, watching their evolution. One of the benefits of being in an angel group is you do de-risk opportunities because there is always someone in the room with some experience in that sector. So we are constantly looking for like-minded people that want to invest collaboratively in the things that we invest in, and not to be afraid of investing. So the question that came up about retail investors, the reality is the early stages of a lot of startups are friends and family. I mean, they would often wear the retail investor hat, for want of a better word. So it's not that you can't invest in early stage if you're not a sophisticated investor. Just be aware that if you don't know an awful lot about something, but you believe in that person and you want to help them along in their journey, maybe you can do one or two of those. Can I say that?
Yeah, sure.
Because,
that makes you an angel investor. You don't have to join a club to be an angel investor.
No, you don't have to join a club. But if you do enjoy it, like I do, and I've been doing it for 7 years, exactly that time frame. And the very first workshop I went to, they said, build a portfolio and have up to 25 companies over a 5 to 7 year period, and hopefully you'll get an exit or two sometime beyond that. My expectation was quite low, so I'm thrilled with what I do. Now I think we should answer this question because it is quite relevant.
Before we do, Aysegul, I think that you raised a really important point which is worth dwelling on from the entrepreneur's point of view. I mean, I was one of the 4 or 5 people that used to sit in a coffee shop in St Lucia when we were trying to establish Brisbane Angels. And then I fast forward to about 10 years later, and I went recently to a sort of a portfolio company roundup, and the room was like packed. There was hundreds of people there. The Angels have now done...
We've done quite a lot of... I can't remember. I think
30 or so investments.
30-something.
30 or so investments. They welcome entrepreneurs into the group, even if they're not portfolio companies. So it is really a good ecosystem and a good place to kind of learn. So I'd commend the group to any entrepreneurs as a contact point.
And the exciting thing is a lot of entrepreneurs want to become angel investors. And isn't that wonderful that they can go on their journey, build their startup?
Well, aren't a lot of you? A lot of you are.
Yeah,
entrepreneurs.
a number of the Brisbane Angels are. Yeah. So maybe we'll tackle this question. It's a bit long. How do regional startups access the personal angel/VC relationships recommended by the panel? And then how does a VC help the startup to grow if not local? Are regional startups doomed? I don't think so.
No, I don't think so. Like, just looking around, it comes back to that, working out the best way to access. Looking around the room, I can see, several people who, if you wanted to get to me through incubators and stuff like Josh and Chris and plenty of guys who you could connect through to the investors and stuff in Brisbane via the hard work they're doing with regional areas like in Ipswich and Toowoomba. And I understand that there's going to be a regional tour done by potentially like one of the accelerators that's already in place to go out to the regional areas and help that access come back. The argument of are regional startups doomed? Look, most of my portfolio is in Sydney, Melbourne. It would probably be easier to get to Toowoomba than out to those sorts of places. We're seeing some exciting agri and farm-based SaaS platforms and things coming through, which tells me that it's exactly the opposite. I actually see them as an untapped resource into sectors that we haven't even started thinking about, but areas which Australia is extremely strong in. It comes down to, look, if your startup can make it work there, fine, but often with any business, you've got to be where your customer base is. And if you're trying to start like an on-demand delivery business from Mount Isa, best of luck to you, because I think you'd be better off being in a capital city to try and make that work. Will it be a lot harder because you're not going to be as visible in the local network? Probably, but impossible, no.
Yeah, and I think that you made a really important point, Dan, and one of my personal areas of interest is food security, being from an agri-biotech background. Not going to find food security agri-businesses generated in Brisbane or Melbourne. They're going to come from the regions. But I think that one of the pieces of advice I'd give to regional startups is to make sure that you've really done your competitor analysis well, because often we see, regional startups that might look within their state or within their country, but maybe not internationally. And we're really trying to build, this is from a VC's perspective, we're interested in global businesses. So being able to dominate southeast Queensland is really not very interesting. So, the same rules around quality of your own market and competitor research apply whether you're from Toowoomba or from Los Angeles. So if you apply those principles, and that's one of the reasons why it's great to be a member of one of these regional incubators, because you'll learn how to do this work well. If you apply those principles, honestly, I don't think it matters where you are.
I totally agree, and I think if you start with the principle that you're building global from day one, they're the things that people are looking to invest in. It wouldn't matter if it was central London business. If that's the only market they're going after, you may make lots of money out of it, but it isn't what I'm looking for. I'm looking for businesses that are going global, thinking global from day one. So you can be anywhere to do that.
We just had a question come up.
We need to read this one.
We've found some VCs around Queensland that ask significant upfront fees for a step in the door. For a startup, capital is its lifeblood. Do you feel there should be more of a performance-based fee for VCs so they can deliver and walk the talk, minimising the risk for the startup? Well, the answer to that is, I doubt that's true, because I know most of the VCs in Queensland, and I do not know a single one that would charge you to walk in the door and do a meeting. That's counterproductive.
Well, I wouldn't have thought they're a VC if they're asking for a fee. That would signal to me they're a broker.
I've heard of some groups that potentially charge you to do due diligence. Like, they go, you want us to do due diligence, you've got to pay an upfront fee. But as a VC, if they're asking you to pay money as you walk in the door and pitch, I would turn around and walk out. Bluntly turn around and walk out, because somewhere along the line a screw is going to be tightened that you're not going to see. That is, people the answer to that is I would walk out the door.
So I think if I could just make a comment, you need to qualify the investors that you're talking to, and if they're a venture capitalist, they should be able to answer two important questions up front. First of all, how much funds have you got under management? Yeah. Because I suspect these people are actually introducers.
Yeah, I think they're brokers.
So do they actually are they actually managing money? And the second question is, who else have you invested in, and can I talk to them? Because I do actually know a VC in Queensland that's no longer around that used to promote this sort of model, and the reality was they actually hadn't placed any money. So ask those questions first, and if you can satisfy yourself on those answers, then you'll screen out, I suggest, those people that are just being predatory, which is really what that behaviour is.
And the second part of that is, I'm not sure I agree that the VC is supposed to come in and minimise the risk for the startup. They're funding you and they'll work with you to minimise the risk for their investors, but it's not the VC's role to do the job of a founder, in my opinion.
Well, I'm just jealous because David's got his own personal question.
Yes.
Should we leave?
Yeah. I'm not entirely sure what I understand by the question, but I'll read it out. So, has industry group-based crowdfunding promotion been more successful than other crowdfunding promotion in the UK, e.g. building industry software startup sourcing crowdfunding by promoting itself to building company workers? I'm not sure that there is industry group-based crowdfunding promotion. What I mean by crowdfunding, and what we're looking at as crowdfunding, is equity crowdfunding. So not crowdfunding that gives money for rewards or something. We're looking at crowdfunding as being an investment vehicle, so putting money in to get equity, the same way I as an angel and Marie as a VC does. So that's the purpose of crowdfunding platforms in the UK that are investing in startups. So they're not industry focused at all. They're all totally agnostic as to what goes on those things. So the answer to that is no. They haven't been more successful because I don't think they exist. So unless I'm confusing what you're asking.
We have, less than 45 seconds. How do you pick awesome startups? Can you actually answer that question?
Well, seeing we've got such a short period of time, I'm going to reiterate a point that was made earlier. I mean, assuming you've got a good product, assuming you've got a good market, it's about the people. I have a little saying. I say, everything that's good that's happened in a company I've been involved with has been about the people, and everything that's bad has been about the people. So I think pick good people and back them hard, and that gives you a better chance of success.
Invest in people smarter than yourself. And pick founders and support them as the asset that they are. Support and invest in the human capital as opposed to the business.
Yeah, it's all about the people. All the ones I've got wrong are where I thought the person was something other than what they turned out to be, or that I thought, well, it doesn't really matter so much. I can help them, change them. You don't go into a relationship thinking, well, if I can only, put her hair the other way, it'll all work out. It's got to be from the start. If you don't like the way the person looks, feels, speaks, talks, walks, whatever, at the start, that's it. Don't do it.
If I can't do a Friday lunch with you, I probably wouldn't invest in you.
Yep. That's about it.
Thank you, everyone. That was great.